The United States government is now $39 trillion in debt. To sustain this, the Treasury relies on a constant stream of global buyers to prevent yield spikes and keep the federal deficit from spiraling out of control. For decades, the primary gauge of this stability has been foreign demand. According to the Treasury Department, foreign investors added $587 billion in treasuries over the last 12 months. This influx has pushed total foreign holdings to a record $9.49 trillion. At this level, foreign entities officially hold 24.5% of all outstanding U.S. Treasury securities. But these headline figures, which are monitored by markets globally, mask a structural shift in how debt ownership is actually categorized. When we compare standard Treasury international capital data against recent Federal Reserve analysis, it reveals that a large portion of this foreign demand originates from U.S.-based entities. To understand the true state of U.S. credit, we have to deconstruct this $9.49 trillion figure and separate genuine geopolitical investment from offshore domestic capital. Peeling back the layers starts with dividing these buyers into two distinct groups, official and private. The official foreign tranche represents central banks and government entities, the capital that defines true geopolitical demand. Growth from these sovereign buyers has effectively stalled, remaining at the $4 trillion level. In contrast, the private foreign tranche has become the primary driver of growth, accelerating sharply to $5.45 trillion. This private sector added $461 billion in just 12 months, vastly outstripping the growth from sovereign governments. Because sovereign nations are no longer soaking up the bulk of new debt, the U.S. is becoming increasingly reliant on opaque private offshore actors to fund its deficit. We can see this shift most clearly in the systematic reduction of debt exposure by traditional sovereign buyers, led by China. Over the past decade, China and Hong Kong have cut their treasury holdings by more than one-third, dropping to a combined $962 billion. While Japan remains the largest overall holder at $1.24 trillion, its holdings are highly volatile. These positions are often used as a tool for currency defense, selling treasuries to support the yen, rather than representing steady long-term demand. On paper, the slack is being picked up by the euro area, which injected $164 billion into the market over the last year, reaching a record $2 trillion. However, there is a glaring anomaly. This capital isn't coming from industrial powerhouses like Germany, which doesn't even make the Treasury's top 20 list of major holders. Actual foreign sovereign demand is retreating. To find the source of this European capital, we have to look at specific financial jurisdictions. This map illustrates the actual flow of capital. This isn't foreign money. It is largely profits from U.S. big tech and big pharma firms, parked in these hubs to optimize taxes, and then recycled back into U.S. treasuries. This creates a significant distortion in the Treasury's classification system. Ireland's $351 billion in treasuries isn't a sign of Irish domestic investment. It is American capital in disguise. A massive portion of foreign demand is simply an accounting artifact of corporate tax strategies. The U.S. is essentially funding its own debt through offshore proxies. The most significant distortion involves the Cayman Islands. Official TIC data attributes $443 billion in Treasury holdings to this location. However, an October report from the Federal Reserve Board of Governors identified a significant structural omission in how TIC data tracks these holdings. The Fed found that the standard data undercounts Cayman-domiciled holdings by $1.4 trillion. This discrepancy is driven almost entirely by U.S.-owned hedge funds that are domiciled in the Caymans for regulatory reasons. These funds use this capital to execute a specific financial maneuver known as the basis trade. In this trade, hedge funds use high leverage to buy Treasury securities while selling Treasury futures, profiting from the minute price differences. This is not stable investment. It is highly leveraged domestic liquidity provision that is vulnerable to market volatility. When these trades seized up in March 2020, it created a liquidity crisis that forced the Federal Reserve to step in and stabilize the Treasury market. This means the largest engine of foreign demand growth is actually fragile, leveraged domestic speculation, which alters the risk profile of the U.S. deficit. If we adjust the official figures to include the Fed's findings, total foreign holdings actually approach $11 trillion. But if we conceptually remove the leveraged hedge fund data and the tax-sheltered corporate data, a different picture emerges. Actual geopolitical sovereign appetite for U.S. debt is currently stalling or shrinking on a global scale. The appearance of robust foreign demand is being sustained by offshore centers recycling U.S.-owned capital back into the domestic market. For analysts, foreign demand can no longer be used as a simple barometer of global confidence. Instead, it has become a measure of U.S. corporate tax sheltering and hedge fund leverage, masking a steady retreat by the world's sovereign buyers.